Here's what's coming up on today's show.
Because ultimately, when it comes to this type of solution, this is for clients that are looking for that exit. So if you want to continue to execute 1031 exchanges, this is not going to be the solution for you, because this will essentially be the last 1031 exchange that you can conduct for that relinquished property or that property that you're selling.
This is the Retire Happy podcast with John Amarino, a fiduciary financial advisor at Securus Financial in the San Diego area, and Thomas O'Connell, president of International Financial Advisory Group, Inc. in Parsippany, New Jersey. Together, they'll be keeping retirement happy from coast to coast.
Welcome back to another episode of the Retire Happy podcast. I'm your host on the West Coast, John Amarino, and I am joined by my good friend and host on the East Coast, Mr. Tom O'Connell. Tommy, how's it going?
Oh, it's going great, John. Summer's been a good summer so far. How about for yourself?
Yes, it's been a very busy, very good summer. Just got back from a couple days in Arizona. The kids went out there for a week, so they got to spend some time with family, and Bree and I went out there later in the week. And other than that, we got a lot going on in the markets as we're recording this, and I've got the new office, so busy but good.
Congratulations on that. Hey, is Jake's team in the Little League World Series competition or no?
No, he's not playing Little League. He plays travel ball, so that's kind of like what Cooperstown is their Little League, but he is, and we just found out it's a 3-day invitational, not 2-day. So this Friday we'll be up in Huntington Beach, and he'll be playing in the California. It's an invitational only tournament, the California Perfect Game All-Star Game. So he's got like 1 day of combines, and they funnel everybody into teams, and then based on points, he may get an invitation to the Nationals in Houston in November. But
awesome.
We'll just stick with that. So, but yeah. So, well, folks, we're coming off of a great podcast talking about trust, and in which I think Tommy and I both learned a lot, and hopefully you did too. And now we're going to talk about a topic that is, you've heard the term 1031 exchange before, but not a lot of people are familiar about it. And, Tommy, I've got a lot of clients that have rental properties, and, they've invested in real estate a while ago. They've got that income stream. But for a lot of people, they are looking to shift out from the property management and they're looking for ways to get out of it. So we have brought on a fantastic host from a fantastic partner of Tommy and I in a huge and great company, Invesco. And our guest today is Kyle Connor, and he is the real estate exchange specialist at Invesco Real Estate. And, his primary goal and responsibility is to really assist financial advisors like Tommy and I, help, navigate our clients through the process of exchanging investment real estate into various private marketing offerings, especially through Invesco. Kyle is actually a San Diego native, born and raised in San Diego, but then he went into Tommy's backyard for a little bit. He lived in the New York area. He has a Bachelor of Science with a concentration in finance from the University of California, Riverside. And we first met Kyle 2 months ago in Denver. He actually was asked to speak at the Advanced Planning Conference that Brookstone put on. So Tommy and I, probably to Kyle's displeasure, he had the time to hang out with Tommy and I for a good part of a Rockies game and after that. So, but hey, you know what, Tommy? He agreed to come on the podcast today, so we must not have been that bad.
It must have been all those beers we fed him.
Yeah. So, folks, without further ado, we'd like to introduce Mr. Kyle Connor.
And today's guest, the real estate exchange specialist at Invesco Real Estate, it's Kyle Connor.
Appreciate John, Tom. Thanks for letting me join the Retire Happy podcast. It's great to be here, and it was great to meet you guys back in Denver a few months back and enjoy the Rockies game with you.
Yeah, it was a fun time, and great presentation. You put on. Tommy and I are always looking to put on, people that know their stuff first of all, but present real well. And Invesco, I've got nothing but love for you and John and all the people at Invesco. You guys have been great partners. So thanks for coming on.
No, I really appreciate it.
So Kyle, let's just start off with the basics. What is a 1031 exchange?
Yeah, no, happy to start there. So really the 1031 exchange requirements in the Internal Revenue Code essentially generally allows for a tax deferred exchange of like kind real estate for held for productive use in trade or business or for investment purposes. So in other words, if you have a rental property or some sort of property that's used for business or investment purposes, it's generally constitutes as a like kind property. And so to execute an exchange, you must hold a like kind and you must exchange it into another like kind. Now, like kind's a very broad term, so that can mean, an apartment building, an office building, raw land, self-storage, farmland, and also a Delaware statutory trust, otherwise known as a DST, also constitutes as a like kind property. Essentially, to defer 100% of your taxes, you do have to sell that property and exchange it for equal to or greater than in value into the replacement property. So in other words, if you sell a property for $1 million, the replacement property must also be $1 million, and 100% of the proceeds must flow into one or more of these kind of like kind properties.
Now, Kyle, if it's not 100%, so let's say you sell the property for $1 million out here in California or in Jersey, and now you're going to buy, a couple rentals in Florida. Could it be? If you bought two different properties, would that work? Or, what if the property's not? You buy the one property, it's 800,000, not $1 million. How would that be handled?
It's a great question. So yes, so in other words, it doesn't have to just be all the proceeds into one property. It can be into a multitude. So if you are, currently owning, let's say, an Airbnb rental, and you're selling it for $1 million, and you found another kind of active real estate property that's worth $800,000, you could exchange the $800,000 in there, and now you still got about $200,000 left if you'd like to defer or have the ability to defer 100% of your taxes. If you don't exchange the rest of that $200,000, that would be considered boot, which would be a taxable event. But that's why there's been a lot of growth in the kind of Delaware statutory trust, or DST, this syndicated environment, as you can kind of right size your investment. So in these types of solutions, they can match exactly the proceeds that you're looking to exchange into, instead of kind of having, in other, rental properties where, depending on what the value is, that's what you're essentially going to be, acquiring.
So just to make sure for the audience, more than anything else, you can't do this with your home, with your residence. It has to be a second property of some sort, right?
That is correct. Yeah. So it cannot be your personal residence use. There are some safe harbor rules around if it's a vacation home. And you could essentially convert your personal, your current residence into some sort of investment property if you were to rent it out. But in other words, it has to be used for some sort of business or trade or investment purposes to constitute as that kind of like kind property.
Right. So now most of our clients have rental properties, whether it's a second home, maybe a multi-family home, piece of property or something like that. Now, when you say like kind exchange, they're looking to get out of being the landlord. At 78 years old, no one wants to go and unplug somebody else's toilet, right? So what you're providing is an avenue where they're not exchanging it from, say, a 3-family home to a 3-family home. This is where Invesco steps in, and it really helps the client diversify their portfolio and get out of the landlord business, but be able to capture the passive income of real estate. Am I right?
That's correct. Yeah. And so one thing actually I should just kind of make kind of a disclaimer at the front end of this call is that, myself nor anybody in Invesco does provide tax advice. So please make sure to, seek out your tax professional, your CPA for any of these types of information.
Very good. We're speaking in very general terms.
Yes.
Yeah.
However, you are spot on. So that, really the goal of Invesco and these types of syndicated solutions is to really help clients that own active real estate or at that point where they're looking to kind of get a bit more of a passive approach and ultimately end up in a diversified portfolio of institutional quality real estate, all on a tax deferred basis.
Excellent.
So you mentioned the Delaware Statutory Trust, the DST. Can we focus in a little bit more on that and how clients, because I have had clients talk, or they've heard of that and they've said, hey, what's his DST and what's good about it and what do we want to be aware of with it?
Yeah. So one thing that I'll actually, before we get into the DST side of it, so there are a few other just requirements on the front end when you are looking or thinking about executing a 1031 exchange. And so as I kind of just stated, preparing and meeting with your CPA is very important because it does need to make sense to sell your property and defer those taxes. And then the second component is engaging with a qualified intermediary, also known as a QI. And so this qualified intermediary really acts as the exchange accommodator. And it provides that kind of buffer because when you sell your property, you cannot take constructive receipt of those proceeds, or that will essentially blow up the exchange. So the QI steps in place. So once you sell your property, proceeds then flow to the qualified intermediary. And then you've got a kind of a shot clock that begins 45 days to identify and 180 days to close into that new replacement property. Now, what this Delaware Statutory Trust really is again, it's a vehicle that holds commercial real estate properties. In the eyes of the IRS, it's this like-kind property. So sponsors like Invesco and others in the industry will bring to market what is called, again, a DST that's going to hold some sort of assets, commercial real estate properties. And we're essentially selling off fractional interest of this trust to match your client's 1031 exchange needs. And so when it comes to the Delaware Statutory Trust structure, again, it's really for the clients that are at that point in time where they no longer want to be an active landlord, manage the 3 T's of real estate, toilets, tenants, and trashes, and are looking for a bit more of a passive approach. And so the DST, when they execute that exchange, again, one thing I'll mention is that the client is selling their property to a willing third-party buyer. Again, those proceeds then flow to the QI. Their shot clock begins of identifying and executing that 1031 into the replacement property. And if they decide to go with the Delaware Statutory Trust route, again, we're going to match up the proceeds that they need to defer 100% of their taxes. Once they execute that exchange into the DST, they will start to immediately receive cash flows. So it's a great way for a predictable, steady stream of cash flow. Again, that kind of passive management approach. And then also you're getting access to kind of institutional quality real estate that many maybe mom and pop investors of real estate wouldn't get access to, given the high prices of actually being able to acquire these types of properties. And so these Delaware Statutory Trust, they'll range in different assets that will be inside them. So the two kind of top asset classes right now that we see a lot in market, I would say, are industrial and multifamily, which are, of course, the hot spots in real estate for it has been for quite some time. But you could also see self-storage and, other, again, just asset classes that are going to be inside of there.
So you're not involved in the client selling that property that they're looking to get out of, right? You're the third party recipient of those funds.
Essentially, yeah. So we're essentially just offering up a replacement property to help your client satisfy that 1031 exchange. Now, one thing I will mention is, again, my sole job here is to help financial advisors like yourself on these 1031 exchange processes and also the end clients. So I do get into the weeds when it comes to talking with end clients, CPAs, QIs. But to your point, yes, that client is going out and finding some sort of buyer that wants to buy their real estate, and then ultimately would be using us as that replacement property to satisfy the exchange.
So now I'm probably dating myself, but I can go back to the days of the Wells REITs and Apple and some of those other ones. And I think back in the day, one of the bigger problems was the leveraging issues, where all of a sudden we saw a big spike in interest rates and the leverage went kind of upside down or backwards. So is this different from a risk perspective for the clients?
Yeah, no, it's a great question. So one thing that's really changed from I would say the old non-traded REIT structure to the new age REIT structure was Reg 1502. And so that's why during that time frame, there wasn't as many institutional quality real estate managers that had non-traded REITs for retail investors, which is why Invesco had launched. We now currently have a non-traded REIT called InREIT that is out in market that you can get through on a cash basis and through the 1031 exchange. But we launched this in kind of the late 2020 post-COVID timeframe. And a lot of other sponsors started launching these non-traded REITs in the 2017, 2018 timeframe when this new regulation came out, given that it was a bit more focused on mitigating the underlying risk to the end investors. And so when it comes to the DST structure, now every sponsor will have some sort of master lease agreement that essentially is in place. And so this master lease agreement can range from 5, 7, 10, or 20 years. And really, the longer the master lease, the more that it's going to really insulate a lot of those risks to the end clients. Now, typically in the DST phase, one thing I'll just mention is that, the client is executing this exchange into the DST for, call it, minimum 2-year hold to be compliant with the Internal Revenue Code. We do say roughly 2.5 or so because it may take 6 to 9 months to close out the offering. But ultimately, when they move into this DST, the master lease agreement is assigned in a way where it's really majority of the expenses are fixed. The variable expenses are minimalized. And really, it's providing that predictable, steady stream of cash flow and really preserving their capital. And that's really the goal of kind of the DST coinciding with the master lease structure. Now, on the leverage side, you will still see leveraged DSTs and offerings in market. Now, but a lot of this leverage is to help the client if they have some mortgage left on their property. So, for example, let's say you've got a $2 million property and you've got $500,000 worth of debt on the property. When you sell that property, 1.5 million will be sitting with the QI at the time of the exchange. Now, to defer 100% of your taxes, you need to get up to that, $2 million mark. And so the leverage within the side of the DST will help replace that $500,000 of debt to help you exchange the entire proceeds and defer the 100% of your taxes in that scenario.
Nice. Okay.
So you had mentioned REITs and whatnot. So to break it down, if a client, if they're going to buy another property, like if they have a rental and they're just going to buy another rental somewhere else, perhaps in another state, they don't need to go through the DST process or whatnot. That would just be the 1031 exchange. You want to get it up to the value, correct?
Correct. So yeah, I guess it's a great point because ultimately when it comes to this type of solution, this is for clients that are looking for that exit. So if you want to continue to execute 1031 exchanges, this is not going to be the solution for you because this will essentially be the last 1031 exchange that you can conduct for that relinquished property or that property that you're selling. So if you want to continue to execute 1031 exchanges, there are standalone DSTs in market that will continue to. So in other words, instead of going into kind of this DST UPREIT program where you end up in a REIT, you could go into a standalone DST, which essentially the whole time would be, call it 5 to 10 years. You might get a bit more of the upside, some total return, depending on the business strategy of the sponsor. And then at a certain time in the future, they're going to sell that property. And then the client has the ability to either execute another 1031 exchange or pay the taxes on those proceeds. So there is a solution for that in market. If you didn't want to go the kind of, again, passive route of it and you still wanted to really actively manage real estate, then you're going to want to go out and just go find yourself some sort of real estate property that you'd like to invest in. And then again, that last kind of piece of the puzzle is the UPREIT solution. And just for the listeners out there, UPREIT stands for Umbrella Partnership Real Estate Investment Trust. And for the solutions that utilize a DST to have you ultimately end up in a diversified REIT, those are the kind of 1031-721 exchanges or UPREIT programs.
So you just mentioned 721 exchange, and I know we've talked about that in the past, in our conversation together. What is a 721 exchange?
Yeah, so the 721 partnership contribution rule states that if you contribute a property in exchange for partnership interest, the IRS will also generally allow you to defer your taxes. So in this 1031-721 exchange solution, you're really combining two of the Internal Revenue codes and helping clients end up in that REIT on a tax deferred basis. So we utilize, again, the DST as the first leg of that stool, where ultimately they're going and exchanging into the DST. They're going to be in there, call it minimum 2 years for safe harbor rules to be compliant with your Internal Revenue Code. And then at the time of the 721 exchange, that's where the REIT will have a fair market value option. So we'll go out and get a third party appraisal and exercise that option and acquire those properties. And we convert the DST investors' interest into what is called operating partnership units of the REIT. And so these operating partnership units are going to be economically equivalent to the underlying common stock share class. But for the benefits of tax deferral, we can't issue your client common stock. We have to issue the partnership units.
So obviously these are programs or strategies that have a more long-term outlook to them. This isn't something for a client to get into and they're expecting to get back out of it in a year or two, right? With that said, people do run into emergencies and problems.
Yep.
So just maybe talk to us a little bit about the liquidity issues, the consequences if need be, getting out early, whether partially or in totality. Just maybe expand on that a little bit.
Yeah, no, happy to. So once the client, so if they use this type of UPREIT program, so they go in the DST phase, they're going to be in there, call it minimum 2 years. Then the REIT exercises the option. Now they're in the REIT, which is again a more of a diversified portfolio with liquidity profiles. They will need to hold those partnership units typically 1 year. So all in, it will be an illiquid investment, call it minimum 3 years for these UPREIT programs. But after that time frame, this is where it becomes a bit more of a financial planning asset for all the financial advisors out there to work with your client on potentially accessing liquidity in part or in whole. Now, one thing I'll mention is that if they do sell a portion of their partnership units, that typically will trigger that taxable event. However, most REITs out in the industry have a liquidity profile of 2% of NAV per month, 5% of NAV per quarter. And when I'm saying NAV, net asset value of the overall REIT. And so typically, if a lot of investors aren't running to the gates at the same time, you'd be able to get your entire or the portion of what you're looking to liquidate out in full. And so when it comes to once you get into the REIT, some of the kind of unique benefits is that you see a lot of clients are using this really as a potential estate planning tool or as that kind of partial liquidity tool, or just utilizing it with their financial advisors to mitigate that tax liability over a number of years. Again, because if you do sell it, you will trigger the taxable event. But given that you are essentially deferring, the majority of what you're deferring is capital gains. There is also inside that taxable event would be depreciation recapture. There's a Medicare tax in there, and there's also state and local taxes. The capital gains portion, if you do have the ability to harvest some losses for that client, you could essentially offset that capital gains portion when you do sell those partnership units. And I'd say just the last bulk of it is, though, we really see the majority of the clients that are using this type of solution is, again, number one, they're at that point in time where they no longer really want to be an active real estate investor, and they're looking for a bit more of a passive solution with a bit more of diversified portfolio of course, institutional quality real estate, and really using this as an estate planning tool where it's a lot easier to pass along these partnership units than a single asset type to their heirs. Now, if you've got, again, a $2 million property, you've got 3 heirs, and they're all in 3 different life stages. So one heir wants to sell the property at the time of their parents passing. The other heir really wants to hold on to it, and the other heir really doesn't even know what they want to do at this point. You could have 3 heirs essentially fighting in the wake of their parents passing. And how this solution helps solve for that is going back to the divisibility aspect of these partnership units. Again, when you sell a single real estate, you're selling the real estate, you're getting your lump sum of cash, and you're going to pay your taxes on it. In this type of solution, you can pass along the divisibility of these partnership units to each of the 3 heirs, and then they can make their own independent decisions what they'd like to do at this time of their parents passing. And the same goes for the tax planning side. Again, it is a part or in whole when you want to liquidate these units.
Now, what would be, because with property, if the step up in basis was passed to the kids, what would be the step up in basis of, since we're talking with the flexibility of this in estate planning, how would that happen in terms of the taxes to the kids?
And knowing that you're not making any giving out any tax advice, Kyle.
Yes,
that is correct, Tom.
Tommy, the compliance head. No, I mean, how does it, in terms of step up in basis?
So the step up in basis, and this is just the great thing about general assets in general, and real estate, it's the same realm of this, is that ultimately when that investor passes away, their beneficiaries or their heirs will receive a step up in basis at the time of death. So in other words, if let's say a client or an investor bought a property for $500,000 and it appreciated to $2 million. You've got a $1.5 million taxable event if you were to sell that outright. Now, if you use this type of solution, when they pass away, their heirs get their cost basis goes up to that $2 million mark. So ultimately, they could sell that property, that single asset real estate, or a solution like ours for a non-taxable event. Now, the part that we also help solve for is that during the DST phase, we're going to be striking a quarterly NAV. So we do quarterly appraisals typically. In the REIT stage, it's also quarterly appraisals, but most of the REITs out in market strike a monthly NAV. So what helps with that is that once that investor passes away, the heirs will know exactly during that month what their step up cost basis essentially will be. Now, if you have a single asset type, the challenge will be is that you need to remember right when your parents pass to go out and get an appraisal to find your true step up in cost basis, which for most heirs, that's the last thing you're thinking about if your parents just passed away, is to go get an appraisal on the property. And so we help solve for that kind of monthly NAV striking, so we'll know exactly what the step up in basis is at the time of death.
Right. Now, there are those, though we typically do not recommend it, people that have commercial properties in qualified accounts. Mm-hmm. So is there something different with the ownership of those, I guess, partnership shares, or how would it work if you did have a client that had something like that?
So it's really going to be who's the actual owner of the real estate. So how is the real estate being owned? Is it in an LLC? Is it in a partnership? Is it just a single entity type? Is it just the individual tax owner? And essentially it goes to whoever the tax identification number on the property is. That is the entity essentially that is executing this 1031 exchange. And so if you own a property in an LLC or a partnership, essentially the LLC or the partnership is the one that is actually going in and executing the 1031 exchange.
Okay. So,
Kyle, we've covered a lot, and I was wondering if we can just kind of do a sample case study.
Yeah.
So Tommy and I, let's say we have clients in their, low to mid 70s. And like Tommy said, they've got a couple rentals and they're just done. So they're selling $1 million worth of property, and they bought this property for $200,000. So they've got an $800,000 capital gain, and they're done, right? That's the sole reason why they're getting out. They're done, but they don't want to have an $800,000 capital gain hit, and they do like the income flow. So we're going into, we're going to contact you and we're going to say, Kyle, this is a situation. So let's take what a client here could expect if that's all right. You know, the timeline, they've already sold the property and we've contacted you and we're gonna implement something, you know, along the lines of a DST.
Yeah. So if they've already sold the property, that means that qualified intermediary is already set up, and that means the proceeds are sitting in cash with that QI, because that's going to be, you know, the main, I'd say, hurdle on the upfront to make sure you can execute that 1031 exchange. And so, to your point, now the shot clock begins. The property's sold, clients are sitting in cash, but the cash is with the qualified intermediary. You now have 45 days to identify a replacement property and 180 days to close into that new replacement property. Now, for a Delaware statutory trust type of solution like ours, I always say, hey, you know, bring us in as soon as possible. So we can, you know, before the property is sold or right when the property is sold, so we can really get all parties involved to make sure that, you know, we can make this a smooth transaction process. And so once I'm brought into the equation, or someone like myself that offers these types of solution, we're going to just you know, help out with the subscription process of really trying to close within that 45-day window. So the thing about the identification window is that if you are due diligencing a multitude of properties, then that's why that identification window is open. So you can identify a few properties and take your time as you continue to the due diligence process. Now, if the client's already, hey, I really don't want to go into another active real estate, I want to take the passive approach, I really like the Invesco solution, so I'm going to go with this. We typically will try to close within that 45 days because there's no reason to wait. Once you execute that exchange into that new property, you start to immediately accrue those cash flows. And so in the DST phase, it's going to be quarterly distributions typically. So quarterly distributions, and that will vary based off of asset class, the market environment, and just the structure of the master lease agreement, and fees is another component as well that will also dip into that cash flow. But once they execute that exchange, they'll receive those quarterly distributions, quarterly statements, and then the annual tax form for DSTs is a substitute 1099. They're going to be in that, again, that DST phase minimum 2 years. And then after that time frame, that's where the 721 exchange comes into play. And so one thing I'll mention is that, again, it's called a fair market value option. The reason it's an option, not an obligation, is to help your clients continue that tax deferral process once they end up in the REIT. And so typically most sponsors that have these UPREIT programs in market, they're most likely going to exercise that option and acquire those properties back, and again, convert the DST investors' interest into the underlying operating partnership units of that REIT. Then again, you're going to hold those for a minimum 1 year, and then all in again, illiquidity, minimum 3 years we'll call. But again, that's when they've now ended up in a diversified portfolio, typically diversified across geographical locations, specialized sectors, in different asset classes. We also see that majority of the REITs have a higher total or income profile in the REIT phase. And also you're going to get a bit more of a capital appreciation as well. You know, typically you'll see total return profiles of 8 to 10%, with half of that coming from the income side. And so that's really kind of the overall process is really just, again, on the front end is engaging with that CPA and that qualified intermediary as soon as possible, or as soon as that client knows they want to defer their taxes. And then once that property is sold to that that willing third party buyer, now you're on the clock to execute that exchange. And again, this type of structure, this type of solution is really helpful for those clients that are just looking for a bit more of a passive ownership and just that predictable steady stream of cash flow and some capital appreciation upside in the REIT profile. One thing you just mentioned too on the clients is that we typically see the average 1031 exchange investor is around that age of 67 to 72 years old. So that's really, again, when most people that have either been owning real estate for the last 15, 20 years and are really looking for that kind of tax deferral exit, that's really some of the ideal client profiles for this type of solution. I'll say one other just kind of ideal profile that also doesn't always come up is business owners. So if you own your business and you also own the underlying real estate, so of course most farmers own the land that they're farming on. Now you will have to strip out the value of the business relative to the underlying property. So typically all you need to do is go out and get an appraisal on the real estate aspect. But for those business owners that are selling their business and the real estate, they can't defer their taxes on the business component. That was a change in the 2017 Tax Cuts and Jobs Act. But they can defer the real estate portion of that business, which we definitely see quite a bit of.
So is there a maturity aspect to owning this asset again? Again, going back to the old REITs, where at some point you're paid out your dividend or your quarterly payment, part of it's income, part of it's return of capital, and then after say 10 years, then it's converted. In the old days, right, it's converted over to a publicly traded thing, and then you have shares to sell. So I guess the short question is there a maturity period time frame where this comes to a conclusion?
So no, but most of these new non-traded REITs that are out in market are perpetual life REITs. Okay. So they are, again, public but non-traded. So they are investing in direct private real estate, and their shelf life is in perpetuity. And so that's why in this type of solution for the 1031 exchange investor, it's a great way to be able to end up in a diversified REIT, park those embedded gains, and again, utilize it as that estate planning kind of tool, and really just kind of collect your income, enjoy your total return and capital appreciation upside, and then ultimately pass it along to your heirs. And of course, you can get that liquidity as well. Now, you also mentioned one component about the difference between whether that income being classified as ordinary income, which of course is taxable, or return of capital, which is non-taxable. And so when you're coming in as a cash investor to that REIT, there's going to be a mix-up. We always say that over a 10-year period, likely 50% of your income will be ordinary income, 50% of it will be return of capital. Now, that's as a cash investor. When you come in via a 1031 exchange and you go into the partnership units, your depreciable basis, so your original basis from the relinquished property that you sold on the front end, will be carried forward. So in that example, you got $1 million property that you're selling, and you bought it for $200,000. That $200,000 basis will be carried forward to the DST phase, and then it'll also be carried forward to the partnership phase. What that essentially means is that this is, again, where it's very important for that tax professional to be involved in this process, because that is an extra tax filing form that they have to declare. But they can continue their depreciation schedule, and as long as the depreciation schedule is the same or above the income they receive, then that income is classified as return of capital. If the client has a zero basis, any income they receive will likely be taxed as ordinary income. Now, what I will say is that you do typically get some benefits of the depreciations that the properties that you're now tied to in the DST phase and in the REIT. So they may kick off some depreciation benefits for that client. However, again, remember, you're not investing in the entire offering, you're getting a fractional interest of that. So in the DST phase, likely you're going to get maybe a sliver of that depreciation benefits, and you may get a bit more once you end up in the partnership phase, given that there's more properties that you're now tied to.
But you are getting the big thing is you're getting that tax deferral, and yes. Right, and you're getting an income, your passive income, which you don't have to unclog a toilet for.
Exactly. No, right. The main benefit of this type of solution is, of course, is helping your client defer their taxes. In the DST phase, the next leg of it's going to be that preservation of capital and that predictable steady stream of cash flow. And again, that's why that master lease structure is in place. And then once you end up in the REIT, again, more passive income and also a bit more of upside potential. And then you also get to kind of really plan your exit. Again, if you want to just park it in perpetuity, you can use it as an estate planning tool. If you wanted to access some of that liquidity, again, that will trigger the taxable event, but you can access some of that. And so really, it's really up to the investor on what they'd like to do once they end up in that kind of last stage of it in the REIT.
Right.
And like you said, you're getting your income stream. You're actually diversifying your risk away from the one property. And then you're, from passing it on to, especially if you have multiple heirs, it's a little bit easier for them to decide what, they're going to do it. And at least in California, I mean, if people choose to hold on to a rental property, the especially if that was under Prop 13, Prop 19 wiped that out. So now all of a sudden, something that may have had a couple $1,000s a year in property taxes, you may now be looking at, $15,000-$20,000 a year, because that property is now worth $1 million, not, 200,000, in which the property taxes may have been based on. So, a lot of good things, but the one bad thing or one thing you just need to be aware of is, just like your real estate before, this isn't, this isn't if you need the liquid money, the lump liquid assets, this isn't something that you're just going to be able to have that liquidity for. And because, like you mentioned, you have the 2.5 years for the IRS, but then, REITs do have, liquidity that you need to be aware of.
Yep. And I'll just say too, is that given the investors that are using this type of solution or just executing 1031 exchanges, if you have a zero basis or a very low basis, if you are planning on selling, out in the future, that is going to trigger that kind of larger tax liability. And so that's where, again, it does become a bit more of a financial planning asset for the financial advisors out there to really help their clients. And one thing I'll just mention as a true benefit for financial advisors is that, again, number one, this is just a great tax deferral strategy that a lot of other family offices are utilizing for their kind of top wealthiest clients that own real estate. And it's really a way of growing your kind of net new asset. So that $2 million property or $1 million property currently was not on the books of that financial advisor. And so it's a great way to grow your billable AUM with sticky assets, with investors that are really focused on their tax liability. So these typically will stick on the books for quite some time.
Great.
Awesome. Well, hey, Kyle, we appreciate you taking time out of your busy day and talking to us about the world of 1031 exchanges and DSTs, because, for a lot of people, it's gonna eventually come up. So thank you. Kyle, of course, is with Invesco. So if you need Kyle's services, well, you're gonna want to call Tommy and I, and we'll hook you up with Kyle. But Kyle is always there for our clients. This is something where Tommy and I have always preached in. This is your episode 94, Kyle. We're coming up on 100 episodes. And, something that Tom and I have always been diligent about is saying, listen, there's the world of investments and planning. There's just so many. You can't be an expert in everything. Right. And to have, people like you, and another shout out to a great friend of ours at Invesco, John Radinsky, to have you guys in our corner. A lot of people understand that when you have the resources that Brookstone Capital Management and have brought to us, and then the outside resources that Tommy and I have sought out to have people like Kyle, while a lot of our clients just see Tommy and I, and we are the head coach of the team, it's a team, and it's a very powerful team of people behind the scenes like Kyle, and the value that you bring to our clients is huge. So we thank you.
Well, I really appreciate it, John. Tom, thanks again for having me on. And again, it's been a great partnership with Brookstone. And again, my sole job here at Invesco is to help advisors and clients with this kind of complex tax deferral world of real estate. So I'm happy to assist. And again, just, thank you for the time.
Thanks. Really appreciate it. We're going to see you in September too, I think, right? At the Brookstone conference, right?
Yep. I'll see you guys in DC.
Awesome. The life of the party, Tommy and I.
Baltimore Oriole game.
Yeah, well, I won't be able to make that one. But well, folks, that wraps up another episode of the Retire Happy podcast. As always, we hope we brought value to your valuable time that you spent listening. We appreciate you listening and subscribing. And if there's any topics you want to learn about as we forge towards our 100th episode, give us a contact us at the retirehappypodcast.com, and we will make sure to get it on. Until next time, folks, retire happy. Take care.
It's easy to get in touch with John and Thomas. If you're more on the West Coast, give John a call at 858-935-6210. That's 858-935-6210, or go online to GoSecurus.com. That's GoSecurus.com. If you're more of an East Coaster, then call Thomas, 973-394-0623. That's 973-394-0623, and online at internationalfinancial.com. That's internationalfinancial.com. And you can, of course, always just check the description or the show notes section of today's show for all that contact information. Don't forget to subscribe on your favorite podcasting apps, and we'll see you next time on the Retire Happy Podcast.
Investment advisory services offered through Brookstone Capital Management, LLC BCM, a registered investment advisor. BCM, Securus Financial, and International Financial Advisory Group are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. The opinions expressed by John Iamarino, Thomas O'Connell, and guests on this show are their own and are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk and, unless otherwise stated, are not guaranteed. Past performance cannot be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it is suitable for your specific situation. This program is designed to provide accurate and authoritative information with regard to the subjects covered. Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interests of our clients and to make full disclosure of any conflicts of interest, if any exist. Please refer to our firm brochure, the ADV 2A Item 4, for additional information.